If you've spent any amount of time on a personal finance side of YouTube, and if you stumble onto this video, you probably have, you'll know exactly what I'm about to talk about. Titles ranging from how I make $3,000 a month in just dividends, to the top 5 yielding dividend ETFs, to how to retire early living off just dividends. Quite frankly, it's everywhere. And look, I'm not here to trash the people making content surrounding dividend investing, and they're not lying to you necessarily, but there's some nuances to dividend investing that get brushed over pretty often. And as a certified financial planner who looks at real portfolios and builds financial plans for a living, I think it's important that people know the truth. Some people might not like to hear this, but I feel obligated to tell you that dividend investing, especially in your 20s, is probably costing young investors more than you'd think. And I hope that by the end of this video, you're going to understand exactly why. So before I get into the problems, I want to give this strategy a fair shake because on face value, dividend investing sounds awesome, and I think it's worth fully understanding before I start to poke little holes in it. The biggest reason dividend investing hooks people is that it makes the progress feel highly tangible. If your portfolio grows from 50,000 to 54,000, that's great, but it's kind of abstract and you can't really touch it. You can't spend that growth without selling something. But if your portfolio deposits $300 into your account this month just for existing, that feels real and tangible, and it's a dopamine hit that unrealized portfolio gains don't quite give you in the same way. Second, dividend strategies tend to come with lower volatility. The companies consistently paying and growing dividends are typically large, established, and mature businesses, what we would sometimes refer to as value companies or value stocks, and their prices don't swing as wildly as the broader market. And after going through a stretch where your portfolio could drop 20% in a month, that stability feels really nice when others might be panicking over the market conditions. And third, this strategy has developed a genuine identity online. The concept of living off dividends is a lifestyle brand at this point. There are subreddits dedicated specifically to people brag posting on how big their monthly dividend yield is, and quite frankly, this strategy has kind of developed its own little personality and subculture. I want to start off and say that there is nothing inherently wrong with owning companies that pay dividends. A huge portion of the market is healthy, well-run companies that pay dividends. If you own a broad index fund, you're already getting dividends. And that's not the issue. Dividends are a fantastic part of a healthy, diversified portfolio, but that's what it should be. It should be a part of a larger overall strategy and plan. And I want to explore some key points as to where this strategy of just dividend investing begins to break down. So pretty much everyone building a dividend-specific portfolio is working towards some sort of target income number. Maybe it's 2,000 a month, maybe it's 5,000, whatever the target number is, it really doesn't matter. But the whole strategy revolves around hitting that specific monthly or quarterly number. The issue here is that inflation is quietly making that number worth less every single year. $3,000 a month that you're targeting today is not the same $3,000 a month in purchasing power 15 years from now. You're actively chasing a goalpost that's moving away from you at the same time, and most people rarely zoom out and adjust their goal number in light of inflation as time moves on. Another issue is when you build your entire investment strategy around chasing just yield, because the companies that pay the highest, most consistent dividends tend to be large, mature, value-oriented businesses, as we discussed earlier. Think utilities, consumer staples, established financial companies, and they're great companies, but their best growth days are largely behind them, and that's kind of the deal. They're returning their cash to shareholders because they don't have better growth-oriented uses for it internally. And you're optimizing your portfolio purely for dividend yield, you're systematically missing the companies that drive the biggest market returns. Think Amazon, Tesla, Meta. These three companies alone have been some of the most significant wealth-generating investments of the last decade, but none of them pay a dividend. Their capital goes back into the business, and dividend-first strategy filters always filter out these companies by default. Now, as I mentioned earlier, and I'll acknowledge and concede this 100%, you do get something in return for just investing in dividend-growing companies. You get lower volatility, less stomach-turning swings, but in your 20s, volatility is not your enemy. If anything, I think volatility can be your friend if you acknowledge it as such and you buy the dips. Time is your biggest asset, and you have decades for the market to recover from nearly any dip. Trading long-term growth for short-term stability and income in your 20s is a trade-off that does not work in your favor over long time horizons. Now, I want to get into my biggest gripe with content covering dividend investing online. Most all creators completely forget that taxes exist and instead focus on reviewing specific ETFs or mutual funds with the highest yield, but fail to acknowledge the biggest enemy of dividend investing, which is taxes. Most people who get into dividend investing do it in a taxable brokerage account, and that's where your strategy starts bleeding money over time. So let's go over how it works. Let's just say, for easy round numbers, you have $100,000 in a dividend focused portfolio held within a standard taxable brokerage account. Your portfolio is yielding around 4%, which shakes out to about $4,000 a year in dividend income, which sounds great. But here's where it gets a little nuanced. Dividends come in two different flavors for tax purposes. You have qualified dividends and non-qualified dividends. Qualified dividends come from stocks that you've held for over a year, and they get taxed at the long-term capital gains rate. For most people in your 20s earning a decent income, that's typically 15%. But here's what most people don't realize. If you're enrolled in a dividend reinvestment plan, which most people doing the strategy are, every reinvestment creates what's called a new cost basis lot. And many of those reinvested dividends get classified as non-qualified because they've been held for less than a year, which means they're getting taxed at not your capital gains rate, but instead at your ordinary income rate. Depending on how much you make and where you fall in the tax brackets, that could be 22, 24% or higher. So you're not just paying 15% on $4,000, you're paying a blend somewhere in the middle, some at 15%, some at your ordinary income tax rate, on dividends that you likely didn't even spend. You're paying taxes on money that went straight back into the portfolio every single year. So the actual after-tax yield on your $100,000 is noticeably lower than the 4% top line number that you thought that you were getting. And on top of that, you add the expense ratio of the ETF or mutual fund that you're invested in that focuses on dividends, and your 4% yield is getting eaten up even further. So what's the fix here? At a minimum, if you're committed to the strategy, regardless of my 2 cents, move it into a qualified account that serves as a tax shelter. Something like a traditional IRA or a 401k that will let you allow the dividends to accrue without the annual tax drag of a standard brokerage account. But again, something else that people don't realize, a lot of people's instinct is to put their dividend stocks into the Roth IRA. And I want to seriously push back on that, because your Roth IRA is the most valuable tax advantage account you will ever have access to. Growth inside our Roth IRA is completely tax-free forever, so what you put in there matters a lot, and you want your highest growth assets in your Roth, because that's where the tax-free compounding does most of the work. An ETF focusing on dividend yield or a value company is not that. You'd be wasting one of the best accounts in the tax code on assets that aren't even going to maximize it. So for my last point here, I want to zoom out and look at these numbers together, because I think this is what really puts it in perspective. Let's look at this chart together. SCHD is probably the most popular dividend ETF out there. If you've seen any of the videos that I mentioned earlier, this ETF has been in it. It holds solid companies and it's delivered respectable returns overall. DOO tracks the S&P 500 as a whole. So let's just look at the past 5 years of performance. And as of this recording, it's April 23rd of 2026. So over that 5-year period, VOO, which again is just tracking the S&P 500 as a whole, significantly outpaced SCHD in total return by nearly 50%. We're talking a gap that on a $100,000 investment is almost a difference of $50,000, and that's before you account for the tax drag that we talked about on dividends in a taxable account. The ending portfolio value difference is astronomical. And what does that difference represent? It could be years of additional runway in retirement. It could be the thing that actually lets you stop working when you want to. And we're just looking at 5 years of returns. The gift of being in our 20s is the fact that we have time. Imagine these two ETFs had another 5, 10, 15 years of similar returns. It'd be serious money you'd be missing out on. And I'm not telling you to invest in VOO, but what I do want to encourage you to do is to diversify your investments across multiple asset classes so your retirement investment strategy doesn't just lean on one pillar of the market and one basket. And here's the thing, dividend investing might make more sense later on in life. When you're approaching retirement, you need your portfolio to generate income without forcing you to sell assets in a down market. The calculation can change, but there are many ways to achieve this without diving headfirst into only dividend yield. But that being said, I can better understand the appeal of this strategy at that stage in life. Even if personally, it's not the approach that I would take, but I say all that to say, I can see the argument more clearly through that lens than someone in their 20s. actually just put out a video on exactly how I'm investing in 2026 as a 25-year-old financial planner. I go through my real allocations, my actual reasoning, and I'll put the link in the description if you'd like a look under the hood of my personal portfolio. In your 20s, the most powerful thing that you have is time. And dividend investing, at its core, is a strategy that trades future growth for present income. When you have 30 or 40 years of compounding ahead of you, it's almost always the wrong trade to take. If this video gave you something to think about, I'd really appreciate a subscribe. It helps more than you know, and it's the best way to make sure that you catch new videos every Tuesday. And if you want to keep this conversation going, if you want to ask questions, talk through your own situation, or just connect with other people figuring out the same stuff, I have a Discord linked below, and I'd love for you to come hang out. It's been Q all, and until next time, enjoy the fog.